this conflict has come at a time when we were looking at another year of 7+% GDP growth in real terms. On Feb 27th, of course, together with Secretary Dr. Garg of Ministry of Statistics, we unveiled the new GDP methodology, base year, new numbers, etc. And we confidently predicted that we are anticipating another year of 7+% GDP growth. But Feb 27 now feels like eons ago. In the light of what has transpired since then. So we now have basically many of the petrochemicals, petroleum products, and the base crude oil that we import are much higher than what they were early in February and also compared to a year earlier. But based on the deft management that the Ministry of Petroleum has done so far, what we gather is that this is only a price shock and not a supply shock also for India, which may be the case for others. So in that sense, as we did in the case of COVID, and in the case of Russia-Ukraine war and what transpired after that, we are managing the supply and the availability aspects of it. But obviously, prices are not in our control because they're internationally determined. Therefore, the decision passes on to what we do with it in terms of domestic prices. So the import dependence comes up, but then again, I think it's important to remember, as one of my colleagues in the government put it, Belgium doesn't grow cocoa, but Belgium is known for its chocolates. Similarly, we don't necessarily have to feel very bad about crude oil import dependence. We have one of the world's most important and largest refining capacities, because when you take rare earths, for example, China is famed for its processing capacity. Even if not all the rare earths and critical minerals are available in China, they could be available in South America and Africa, etc. But the processing capacity makes a difference. And when it comes to petroleum products, we are doing the value addition part of it, even though it is quite small when it comes to petroleum products. So I think we need to keep this crude oil import dependence in some perspective, because whatever else we substitute it with also will have import components, and sometimes from even more hostile sources than what you could find from the Gulf. So that is something to keep in mind. But the point remains that on the right side, what I'm showing you is the key one. This particular conflict, which is going to be on a low simmer or a high flame situation, whatever it is going to be there with us in some form or the other, because the military conflict may be over, but the strategic contest is well and truly alive. It will be so for some time. And it has 4 channels of shock. One is the price and supply shock, although I told you a minute ago that supply shock is not that big for us. This is the price shock. But then there is also an impact on trade in general as global growth slows down and the Gulf economies slow down. You have a trade impact. Then you have the logistics cost impact, which are going to be sticky. Normally, they don't come down that easily once they go up. And the uncertainty will remain. Therefore, insurance and freight costs will not necessarily return very quickly to pre-Feb 28 levels. And then the remittance shock, given that we get $120 billion in remittances in general, 80 from workers, of which 30 to 40 billion comes from Gulf region. You could come up with your own estimate of how much will be lost, which will be only a guesstimate at this point. But these 4 channels are the channels through which we are going to face the macroeconomic impact in 26-27. Naturally, all these things will, the higher import prices, the lower remittances, will have implications for current account deficit, which was very tame in FY26, estimated to be less than 1% of GDP. But nonetheless, in the last 2 years, 24-25 and 25-26, if you look at the red color bar or the orange, it is shorter than the blue color bar. As long as the red color bar has been taller than the blue color bar, which means capital account has been comfortably financing the current account, but that was not the case in the last 2 years due to a combination of unique circumstances. I still wouldn't call it that India was kind of went out of investors' radar or favor, because if you look at the numbers for 25-26 in gross FDI terms, for 11 months of data we have about close to $88 billion of gross FDI which we have broken out of the range of $70 to $80 billion, which we were sort of living with in the previous 5 years. So I hope with one more month of data to come, we may end up FY26 with a gross FDI number of close to about $90 or $95 billion, which is an important sign that investors have not given up investing in India or viewing India as an investment destination. And the spate of free trade agreements which you have signed, some of them will come into effect this year. The UK one hopefully this month in May, and the EU agreement sometime hopefully before the calendar year is out. Those things also will hopefully convince global manufacturers that India isn't facing high tariff along with the interim agreement with the United States. So therefore, to some extent, India as a center of production, both for the domestic market and for the global market, because we are not facing high tariffs, that can also be a magnet. So I do hope that in FY27, we will see the improvement in the gross FDI numbers continue. On the net FDI side, I think we were a victim of our own success in having a very deep equity market with a very healthy IPO pipeline. So many PE VC investors found it easier to exit from India to compensate for their inability to exit from other markets. But nonetheless, I think this is a challenge for this year because the current account deficit could widen from less than 1% of GDP to anywhere near 2+% of GDP, which we have to finance. And that means we have to make ourselves always attractive for investment in general, both domestic and foreign, and that is something we need to do it in order to also attain future strategic leverage.